Good morning, guys, and welcome to the Camp Financial Stock Market Update. So, we're going to do a very short and to the point on the market as a whole. As Friday, again, the markets continue to push new all-time highs. S&P definitely broke through that 2250. It never came back down. It pushed up to almost 2260 by the end of the day. The Dow Jones Industrial Average is now just 240 points, about 1%. I guess we'll call it maybe 1.25%, about 1.25% from hitting Dow 20,000, which would be pretty phenomenal for sure. Pretty impressive. I mean, people have been talking about it for a long time. It'd be interesting to see it finally get there. So, but I guess kind of separate from all that, in line with all that, you know, however you want to look at it, I mean, it's been a pretty outstanding run, I guess, that the market's on here. And again, when markets are strong is when you should always be prepared to protect your capital. I mean, it's when markets go bad, that's when you're looking to put capital to work, because typically you're going to be able to find bargains, etc. Or that's the old tenet from Warren Buffett, still holds true. Be greedy when others are fearful, and fearful when others are greedy. So I'm not saying you need to sell everything right now. Definitely not. I mean, I'm 80% invested essentially, so there's no problem with continuing to hold in your stocks. Just know what prices you're willing to get out at. Where you're going to get out if they come down. So today, actually, more so, I wanted to focus on doing a quick dividend explanation of dividends. So I guess first, so what is a dividend? A dividend is essentially, it's very similar to the interest that you would be paid if you had your money in a bank. Essentially, a dividend from a company is a distribution from that company. It's a part of their earnings, a part of their capital that they're going to distribute to the shareholders as decided on by their board of directors. So that can be in cash, it could be in stock, or something else. So the dividend. So if you have a $10 stock and they pay a 10-cent quarterly dividend, so that's 1% of the stock price per quarter, that's a 4% stock yield, or a 4% dividend yield. That's like I said, that's a distribution from their capital back to the shareholders. So it's going to lower their earnings per share. Well, it's not going to lower their earnings per share, but it's going to lower the amount of cash that they have on hand. So that's one of the key things to look at. Another is to look at, and we'll dig in further into this, I guess, over the next few episodes. But so with the dividend, you want to make sure that the company has enough cash to pay its dividend, right? So a company that's only earning 30 cents a year, that's paying a 10-cent dividend per quarter, is quickly going to start running out, because they're paying out 40 cents, but they're only earning 30 cents. They're quickly going to start running out of cash on hand to pay that dividend. So, something like that should concern you as a stockholder as to where they're going to come up with that additional capital. Um, if they have enough, if they're making $1.60 and they're paying out 40 cents, that's only 25% of their earnings per share. That's going to make it much simpler for the company to continue to pay that dividend, and puts them in a strong financial position going forward. So there's just a few little bits on dividends. If you have any additional specific questions about dividends, I'd love to put them out there, through this show. So that is going to be it for today, though, guys. Take care, and we will see you tomorrow.